What's up everybody, I am Jaspreet Singh and the housing market has been creating a lot of tension lately. Home affordability has dropped to its lowest levels ever, and that means it's becoming harder and harder for somebody to go out and buy a home, especially first-time home buyers. And for the most part, that translates to no other than the Lululemon wearing, Frappo Macchiato sipping, and the extra guac eating millennials. Millennials have been fortunate enough to live through two different housing crises, which translates to millennials having the lowest rate of home ownership ever. Now, of course, part of it has to do with the spending habits of millennials who love spending money on Lululemon and Frappo Macchiatos at Starbucks and, of course, the extra guac at Chipotle. But you can't ignore the fact that housing is becoming extremely expensive, which is making it very difficult for all people, millennials, old people, young people, to go out and buy a home. This dilemma is now pushing more people to rent than buy, which is now pushing rental prices up through the roof too. Rent prices have been skyrocketing across the country, and some areas have even seen rent prices grow by 40% in just the last year. This housing market issue has become so bad that our friendly neighborhood financial savior is now coming to the rescue again. And this time, it's not Jerome Powell and the Fed with their money printer. This time around, our financial savior is the United States government. Home prices have gotten so far out of hand that now the government says that they will be backing mortgages up to $1 million in some areas, and they're also loosening our refinancing restrictions to make it easier for you to borrow money against your home. Home prices have become so expensive because of government programs, because the United States government wanted to create more inflation and they wanted to lower interest rates, making it more easy for people to go out and buy a home. And now that they've done that, home prices have gone up so much, and so their solution is, well, let's make it even easier for people to go out and buy bigger homes and borrow more money, which would ultimately make home prices go up even more. Wait, isn't this just gonna make the home affordability problem worse? Shh, just listen to the sound of the money printer. What's even more interesting is their reasoning, because Fannie Mae and Freddie Mac published a blog post on their website saying that this housing market is the new normal. What makes all of this so concerning is that it's all happening at a time where the Fed wants to start raising interest rates to fight inflation. It's no surprise that we're seeing record high inflation, which is why the Federal Reserve Bank is now saying that they want to start raising interest rates to fight inflation, and we might even see our first rate hike in March. If you want to understand how all these things are going to affect the housing market in the future, you have to understand where we came from, at least over the last couple of years. In January of 2020, we were already in a strange housing market because the government wanted to stimulate the economy. In 2019, if you wanted to go out and get a mortgage, it was going to cost you something around 4.5% a year. But then under President Donald Trump, he pressured the Federal Reserve Bank to slash interest rates. And so in January of 2020, if you wanted to go out and get a mortgage, it was only going to cost you something like 3.7% a year if you got a fixed rate 30-year mortgage. Now, the reason why they started to do that was because they wanted to stimulate the economy and they wanted to stimulate the housing market. When interest rates go down, more people are likely to go out and buy a home. And so when this happened in January of 2020, we were already seeing record low inventories of homes. So people were struggling to get a home at this time because people were trying to capitalize on these low interest rates, and there weren't that many homes available for sale. So the supply issue of homes started before the pandemic even started. In January 2020, we had that low inventory issue, and at this time, the median home price was $295,000 in the United States of America. Then came the pandemic, and in April of 2020, that's when we saw listings freeze. People were scared of the pandemic, nobody knew what was going on, and that's when the Federal Reserve Bank started slashing interest rates because they wanted to stimulate the economy. The entire country shut down, so nothing was moving, and so the only way that they could stimulate was by creating more inflation. So in April of 2020, if you wanted to get a mortgage, it would be right around 3.3% a year, assuming you get a 30-year fixed. And the interesting thing here was that nobody was buying home. The average home sat on the market for 62 days because people didn't know what was going on with this pandemic and people were not buying homes. That's when the early movers who wanted to capitalize on the low mortgage rates came out and they started buying homes. By October of 2020, mortgage rates had fallen to 2.8%, and the average days on market for homes fell to 53 days because now people wanted to scoop up the homes, and this is when we really started to see the listing issue where there was a very small supply of homes. So now everybody who wanted to take advantage of these low mortgage rates and home prices that had not skyrocketed did that between April and October of 2020 because you didn't see massive home price growth yet, but the people here were able to capitalize on these super low mortgage rates and were buying homes before they really started to skyrocket. This is when sellers started to catch on. They realized that there's not that many homes available for sale, and you're starting to see more and more buyers enter the market who want to capitalize on these low mortgage rates. So that's when home prices really started to go up. By March of 2021, sorry if you can't read my handwriting, by March of 2021, now the inventory issues really are becoming big issues because the inventory of homes are less than 50% of what they were just 1 year ago, and now you can still get a mortgage for right around 2.8% a year. But the craziest part is that in October of 2021, the median home price in America jumped up from $295,000 in January of 2020 to $370,000 just over a year later. 2021 was the year of the housing market because the market kept booming because everybody started to have FOMO. They didn't want to miss out on this housing market trend, so everybody tried to go out and buy a home. And then by October of 2021, you started to see mortgage rates go up slightly. By October, the average mortgage rate for a 30-year fixed rate was around 3% a year. But also by this time, the days on market fell to about 45 days on market, and the median listing price for a home in America jumped up to $380,000. Then came January of 2022, where now the Federal Reserve Bank really started to issue some warning signals about inflation, and they said that they were going to start raising interest rates because of all this inflation, and that's where we saw mortgage rates start to pick up. Mortgage rates went up to about 3.45% for a 30-year fixed in January 2022, which is still historically very low, and this is before the Fed has really started to ramp up interest rates, so you can expect interest rates to continue to go up in 2022. But even with the higher interest rates, January of 2022 was the hottest January in the housing market in recorded history. So now that you understand where we were, let's talk about where we're going, and we can start by going to smash that thumbs up button below. Fannie Mae has said that they project home prices to go up by 7.6% in 2022. At the same time, it's projected that wages will continue to grow quite a bit in 2022, but it's not going to keep up with home prices. We've never really seen that happen, but it's projected that wages will grow by 3.4% in 2022. What this means is that home prices will become even less affordable in 2022 because on one hand, you have home prices that are growing significantly faster than wages, but then on top of that, homes are naturally going to become even more expensive because interest rates are going to go up. The Federal Reserve Bank has said that they want to increase interest rates multiple times in 2022, which means your mortgage is going to become more expensive if you go out to get a mortgage in later 2022 or in 2023. So it looks like the home affordability crisis might be getting worse. Generally speaking, it's hard to have a housing market that's growing in price significantly faster than wages because that means over time you're going to have less and less people that are going to be able to afford a home. So you want to see wages keeping up with home prices, but the reason why that's not been happening is because you've had low supply of homes with a very high demand of homes coupled with super low mortgage rates. On the supply side of things, it's no surprise that we have a limited amount of homes available for sale. It's not just the fact that people aren't selling homes fast enough, we don't have enough homes in the country to meet our growing demand. Core logic says that we will need about another 5 million homes to meet the amount of demand that we have for homes, and we just can't build homes fast enough. I mean, not only are we having trouble sourcing the materials, the lumber, and all the other parts, but we also have a labor shortage. Remember the Great Resignation? And so you have a lot of construction companies that are struggling to find labor to build homes, and if they are able to find labor, the labor today is costing them a lot more today than what it did a few years ago, and so all these things are pushing the price of homes up because you just can't build homes fast enough or as inexpensive enough. Just a few years ago, you used to be able to build a nice starter home for about $250,000 in a big chunk of the United States, but today, to build that exact same starter home, it's going to cost you 1.5 times that because of the higher cost of materials and the higher cost of labor. So just like everything else, one of the biggest issues in the housing market right now is that we have a very small supply of homes available for sale, and we're starting to see the supply inch up, but it's still nowhere near near where we need it to be to help meet all the demand. On the flip side, the demand side of things, we've seen the complete opposite. We have a booming demand for homes because of a couple reasons. One is because of low interest rates, but the unexpected reason is the change in our economic environment. When we entered the pandemic and the initial recession, the Fed started cutting interest rates to stimulate the economy because when interest rates are low, more people are more likely to go out and buy a home. And when people are buying homes, well then real estate agents are getting paid, title companies are getting paid, mortgage bankers are getting paid, the bank companies are getting paid, contractors are getting paid. So it helps grow the economy when people are buying homes. But the unexpected thing that happened was the shift in our economy, because what happened was we saw the shift to the work from home movement, where people realized, oh, I don't have to go into the office to go and work. And so people wanted to now move out of the cities into suburbs, and they wanted a home where they can upgrade, where they can have their own office, and where they can spend more time. So now people naturally wanted to buy a home because they wanted to upgrade and have a home that they could work out of. When you couple that economic shift with the lowest mortgage rates in the history of time, well, you create one of the biggest demand booms in the housing market that we have ever seen in our history. If we zoom out and think about this on a smaller scale, think about it this way. If you have 5 sellers of homes and you have 5 people that want to buy homes, it's an equal supply and demand. And so it's not like one party has a bigger upper hand over the other party, because if you look at one home and you don't like it, well, you can look at the other home or the third home. But now if we have 5 homes available for sale and you have 100 people that want to buy these 5 homes, now you don't have that same type of leverage, because if you don't like this home, well, you might lose it to somebody else. And if you don't like this home, well, you might not even get it because you have 20 other people that are trying to buy this home. And so when you have a lot more demand than supply, well, now you want to buy this home and you know that you're competing against 20 other people. And so now if you want to get this home, you have to be willing to pay more money. You are competing against all the buyers, and that's what we've been seeing happen, and that's what we're going to continue to see happen until we see more supply or until this demand starts to go away. Now, one of the reasons we can see this demand slow down is if homes become even more expensive. Now, that can happen through higher home prices, but that can also happen through mortgage rates going up. And we know that mortgage rates are expected to go up in 2022. What that means on your end is if you want to lock in a low mortgage rate or a refinance rate, it's better to do that sooner rather than later, because we're already starting to see mortgage and refinance rates start to creep upwards. And when the Fed starts to raise interest rates, you can bet that mortgage and refinance rates are going to go up even more. So if you want to lock in these rates, you don't want to keep waiting, because if you do, then you're going to be the one paying the higher prices for your mortgage or refinance. And as a little tip, make sure you shop around, because some lenders are going to charge you a whole lot more in interest and a whole lot more in fees on the exact same loan. So if you're going to be borrowing $500,000, you might as well borrow it from the lender that's charging you the least amount of money. And luckily, thanks to the internet, you can just use a mortgage comparison tool, which will help you do that, so you don't have to hound each one of the lenders and try to call around and try to figure out each individual lender's rate. And the following is an advertisement from our sponsor Credible, who operates a mortgage comparison website. At Credible, you can check pre-qualified mortgage or refinance rates at no charge to you. They have multiple lenders competing on their marketplace, so you can go on there and compare great rates and pick the option that's best for you. The process is super simple. All you have to do is go onto Credible's website and enter in a few pieces of information, which just takes a couple minutes, and then Credible will present you with actual pre-qualified rates from different lenders. That way you can compare. Their pre-qualification process is easy to use. It only takes a few minutes, and checking pre-qualified rates does not affect your credit score. So if you want to learn more and see what mortgage or refinance rates you might qualify for, I'll put the link to where you can do that with Credible in the description below. Credible does pay minority mindset and advertising fee when you submit a pre-qualification request, and Credible Operations Inc. NMLS number 1681276 is not available in all states. So if you want to learn more and see what mortgage or refinance rates you might qualify for, I'll put the link to where you can do that in the description below. What we've seen happen time and time again in history is every time the government sees a problem and they try to fix it, they end up making the problem worse. And the concern is that we might see that the exact same thing happen now in the housing market. In this case, to help combat rising home prices, what the government wants to do is they say that they will be willing to back loans up to $1 million or almost $1 million in certain areas around the country. Fannie Mae and Freddie Mac are government-sponsored entities who have one goal. They want to help more Americans become homeowners. They're not issuing loans directly to people, so you can't go out and borrow money from Fannie Mae and Freddie Mac. Instead, what you do is you go and borrow money from a lender or a bank, and then Fannie Mae and Freddie Mac tell the bank or the lender, hey, don't worry, we will insure the loan that you just gave out. When a bank lends out money to you, they're making an investment. And so when they make this investment decision, they want to make sure that they get their money back. That's why they look at things like your credit score and your income and how long you've been getting paid. And so if you go to the bank and you don't have the best credit score or you don't have a great work history, then the bank is probably going to say, no, we don't trust you with our money, because if you don't pay the bank back, well, then the bank's money is at risk, and nobody likes losing their own money. So let's assume that this is you. I'm going to draw a nice mustache for our male followers, and I'm going to draw a nice braid for our female followers, or as we like to call it in my native language, Punjabi, a gut. Now, you go to the bank and you want to get a mortgage. The only problem is you don't have a lot of money for a down payment and you don't have the best credit score. Typically, the bank's gonna look at you and say, no, we don't trust you with our money. You are a risky investment, because the bank doesn't want to lose their own money. But the problem that the government had with that is that if the bank is rejecting a whole bunch of people on their home loans, well, then people won't be able to buy homes, and that's gonna hurt the economy, and that doesn't look like a good thing to the government. So what we have here are your government agencies. In this case, it is Fannie Mae and Freddie Mac. Now, Fannie Mae and Freddie Mac were private entities, but then after the 2008 real estate collapse, they became absorbed by the government, and now they are government-sponsored entities, which means they're kind of private, kind of governmentized, and so it's somewhere in the middle. And so what happens here is Fannie Mae and Freddie Mac will then buy the loans from the bank to insure the bank against these loans to people who are getting things like an FHA mortgage. So again, an FHA mortgage is where now you have to buy a home and you don't have the best down payment. Maybe now you're only putting 3.5% down, and maybe you don't have the best credit score. You can qualify for an FHA mortgage. The bank will give you money, and then the bank is going to sell your loan to the government agency, in this case Fannie Mae and Freddie Mac, which insures the bank. So now the bank doesn't have to worry if your credit score isn't the best. The bank doesn't have to worry if you don't have the best down payment, because it's not the bank's problem. So now Fannie Mae and Freddie Mac are buying these loans, and they also get some insurance to help protect them, but Fannie Mae and Freddie Mac are also backed by the full faith and credit of the, put it this way, United States government. Now that sounds really nice in theory, because now your bank is supported by the Fannie Mae and Freddie Mac, and Fannie Mae and Freddie Mac are backed by the United States government. The only problem is the United States government doesn't have any money. The United States government is drowning in debt. They barely have enough money to pay their bills as it is. So if the United States government is backing Fannie Mae and Freddie Mac, how are they supposed to do anything if Fannie Mae and Freddie Mac run into issues where people start defaulting on their mortgages? Well, that brings up the next question. Who is backing the United States government? Well, to answer that question, you have to understand who is funding the United States government. The person who's funding the United States government is none other than you. Taxpayers. Taxpayers are the people that are backing the United States government, because if it wasn't for your tax dollars, the United States government wouldn't have any money to do, well, anything. The reason why this is so important to understand, because now we are seeing home prices go up so fast, and part of the reason why we're seeing home prices go up so fast is because we're seeing unprecedented demand. And one of the reasons why we're seeing such high demand for homes is because a lot of people can buy homes even if they don't have a very high down payment, and even if they don't have the best credit score. And now, to help more and more people buy a home in this home affordability crisis, what the government wants to do is they want to increase the size of loan that you get from here, because previously the loan sizes were smaller, and now in some areas they're saying that they will be willing to back loans up to nearly $1 million, which means now we'll have more people be able to go out and buy a home, which means that there'll be a bigger demand, which ultimately means that that would help push home prices higher, or at least keep them high. Now, if you're wondering whether this is a good thing or a bad thing, it really just depends on who you are and where you are in this situation. Because if you want to go out and buy a home, well, then this is a good thing, because now you can go out and get an FHA loan at a higher price. But if you don't plan on buying a home for a little while, well, then this is bad news, because this will help push home prices even higher. And if you own a home right now, then this is good news, because that means home prices will continue to go up, because now you'll have more buyers coming in. So it's good news for some, bad news for others, and it's okay news for people in the middle. It just depends on who you are and where you are in the situation, which is why the saying one person's trash is another person's treasure is so true, especially when it comes to money. We're seeing similar changes go into effect on the refinancing side of things too, because the government has said that they're willing to loosen the restrictions for some of the refinancing, and they're willing to increase the amount of money that you can pull out, again, to help stimulate this business. The concern that everybody has in the back of their mind is, do these programs create a bigger housing bubble? Because remember, before the 2008 crash, one of the biggest factors leading up to that collapse was a lot of people started to buy homes who shouldn't have bought a home. And so if we are loosening restrictions, we're increasing the amount of money that we're lending out, could this create a similar type of bubble? The thing that I always find funny goes back to what I said just a minute ago, because oftentimes the things that the government tries to do to help people oftentimes end up hurting those same people. If you go back to the CNBC article talking about the mortgage refinance programs, the first bullet point says that the goal of Fannie Mae and Freddie Mac's refi program is to help low and moderate income homeowners take advantage of historically low mortgage rates. In other words, they want to help not rich people go deeper into debt. Now, what are people going to do with their debt? If you use this debt to go out and buy a rental property or go out and invest in a business and do something to create more wealth, then that's a good thing. But if people are refinancing cash out of their homes and they're not doing that, and they're taking this money and they're going on a vacation, and they're taking this money to go out and buy some new clothes, and they're taking this money to go out and buy a new car, is that really helping the low and middle class people? Again, it depends on what side you're on. On one side, you can say, yes, it's helping them. It's helping people buy the things that they want, and it's going to help stimulate the economy, which means it makes wealthy people wealthier, because now if you own shares of the companies that these people are buying products of, well, you're becoming wealthier because now people can buy more things. But on the flip side, if we just look at the financial education side of things, especially because I am a money nerd and I like spreading this financial education, then it doesn't look so good. Because now you are going deeper into debt and you have no financial education, and now you borrow more money at record high prices, and now you are using this money to make yourself broker, and now you are left with just a mountain of debt. The one point that I want to hammer home here is that none of this is a problem until it becomes a problem. Like, credit card debt doesn't become a problem until it is a problem. And too much mortgage debt and being over leveraged isn't a problem until it becomes a problem. If home prices fall and people start to become overwater because they over refinanced or they bought a home that they couldn't afford, well, that's when it becomes a problem. But when home prices are going up and everybody has equity in their homes and everybody has a job, it's not a problem. It's helping to grow the economy, and everybody who's taking part in it is a financial genius. But what you have to remember is good times don't last, and either do bad times. Everything goes in cycles. You have booms and you have busts, and you want to be prepared for anything, which is why it pays to be financially educated, which is why you want to be aware of what's going on. What's up, everybody? If you want to continue building your financial education, I linked a relevant video here that I think you'll love, and as an added bonus, I have a free guide on how you can start generating passive income that you can download and read for free. All you gotta do is click that button below. Average millennial is gonna get something like $210,000 past